Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. The Consumer Price Index data for January has now been released, and it shows that prices fell at the fastest rate for 14 years, the fastest since September 2009. And this is now becoming a major problem in China. This is the fourth consecutive month that we've seen year-on-year price declines. Deflation is now hurting the Chinese economy, and this is causing major problems for Chinese corporates. And the Producer Price Index, also known as the factory gate prices, also fell in January, and this was the 16th consecutive month of such price falls. So this is now becoming entrenched in the Chinese economy, and Chinese consumers are changing the way that they're approaching things. They're changing their buying patterns, and food prices fell in January at their fastest rate for more than 20 years. So this is becoming a major problem because China is forecasting growth of around 5% in GDP for the whole of 2024. But unfortunately, domestic demand is now at an all-time low, and that's going to prove a major problem because when you've got 1.4 billion people, you need those people to be buying things, to be fueling your economy, not dragging it down. So in today's video, we'll have a look at the data that's been released on the Consumer Price Index. We'll also have a look at what's going on with food prices and the producer prices. We'll also have a look at what's going on in manufacturing because there's been more bad news released over the last few days in terms of what's happening in the factories. We'll then talk about what's happening with the stock market and the Chinese yuan, with both of which have been under pressure over the last few months. And then finally today, I'll wrap up with my summary as to what I think is going on in China right now and what's likely to happen over the course of the next 3 to 6 months. But before we get started on all of that, I'd like to say thank you so much to everyone that's supporting the channel. If you've bought me a coffee, sent me a YouTube super thanks, or signed up as a Patreon or a member, thank you so much. Your support really does mean a lot to me, and it helps to keep the channel going. This chart shows the movement in consumer prices in China over the last 12 months. And as you can see, the latest data for January show that year-on-year prices fell by 0.8%. And this is now the fourth consecutive month that China has recorded year-on-year price falls. And over the last 8 months since June 2023, China has only seen a price increase in 1 month, in August, and that was 0.1%. So what we're seeing here is deflation is becoming entrenched into the Chinese economy and also into Chinese buying patterns. And if we expand the chart out to show the position over the last 10 years, you can see that the current fall in prices is the worst that China has seen at any point in the last decade. And if we expand the chart out further to show the position over the last 25 years, you can see that the current situation is the worst that China has experienced since September 2009. And this really puts into perspective just how serious this situation is. This chart shows the movement in food prices over the last 12 months, and as you can see, in every one of the last 7 months, China has seen a fall in food prices. And the year-on-year fall of 5.9% seen in January shows that food price decreases are now accelerating. And if we expand this chart out to show the last 10 years, the current rate of price falls is the worst that China has experienced at any point in the last decade. And if we expand the chart further to show the position over the last 25 years, you can see that the current rate is the worst that China has experienced since the late 1990s, so over 20 years. Now, normally when we're talking about food inflation, we're talking about price increases. And I highlight this as an issue because the poorest members of society are the people who suffer the worst. They have the least disposable income and tend to spend a higher percentage of their earnings on food. So when food prices are rising rapidly, they suffer the most. But in this situation, it's slightly different. Food prices are now falling at an accelerating rate in China. So obviously that represents potential good news for consumers because when prices are falling, you can afford to buy more. So for the poorest members of society, this potentially represents good news. However, it represents extremely bad news for Chinese businesses. The companies that are producing food are seeing the sales price of their products falling on the shelves, at a time when their costs are not falling at the same rate. So basically, they're making either less profit or even now making losses on those sales. And that's going to represent serious issues for those companies, because when you're planning ahead, when you're trying to forecast what's going to happen over the next 3 to 6 months, you need to know what your prices are. If your prices are constantly falling, then that means that you need to keep cutting your costs. So you may need to release staff, so sack people, or reduce their wages, or try to bring your costs down in another manner. But that's very difficult to do. So all of these businesses are now coming under increasing pressure. And what that potentially means is that some of them could go out of business, and we could start seeing shortages of certain types of food in China if this situation persists over the long term. So whilst in theory falling prices for food on the shelves is good news for consumers, actually it could represent really bad news in the long term if we see a shakeout of a lot of these companies, less competition, because when things start to return back to normal, that could mean that prices could start accelerating really rapidly. So we could have a boom and bust situation in the food market in China. This chart shows the movement in producer prices in China over the last 12 months, and this is also referred to as factory gate prices, and that's basically the price that companies are charging when products leave their factory. And as you can see, in every single one of the last 12 months, there has been a year-on-year fall in producer prices. And actually, as I mentioned at the start of the video, we're now into the 16th consecutive month of falling producer prices. And as I just discussed, this represents bad news for companies, because if your prices are constantly falling, you're constantly having to find ways to either cut your costs, or you're just making less profit and maybe even a loss. And so this is a seriously bad situation for companies to be in, because it makes it very difficult to plan for the future. If you've got continued rising prices, you can build that into your financial modelling. You can start working out how much extra you can spend on staff and input costs. But when you've got falling prices like China has at the moment, it makes it extremely difficult to budget for the future, because you're having to rely on things like cutting your costs just to make the same level of profit. And obviously that's very difficult to do, because there are a certain number of employees that you will need to produce all of your goods, and unless you can cut their wages, it's impossible to cut your costs. So the only other way is really to cut down your raw material costs. But that's also very difficult, because it relies upon other companies selling things to you at a lower price. Now for China, if you're just sourcing from other Chinese companies, then there is a potential that you could be sourcing things at a lower cost, because factory gate prices have been falling for 16 months. But if you're buying raw materials from overseas, then it becomes a problem, because generally speaking, prices rise year on year. And also, we've seen a fall in the value of the Chinese yuan. And if these companies are having to buy things in the international markets, they will need to exchange yuan for other currencies. And as the value falls, that means that things become relatively more expensive. So you can start to see why the pressure is now being applied on these companies, and how it's very difficult to be able to turn this around. And this chart shows both the producer price index and the consumer price index, so inflation, dating back to 2009. The producer price index is shown by the grey line, and the consumer price index is shown by the red line. And the reason that I wanted to share this graph is I thought it was very interesting to see that the producer price index has actually been falling in a number of periods over the last 15 years. Prior to the current period, the last time that China saw falling producer prices was in 2019 and 2020, which was at the time of the COVID-19 pandemic, when China needed to cut its prices to keep selling all of its volumes. So that's really an understandable fall. But if we look at the period before that, between 2012 and 2017, there was a prolonged period of falling producer prices. And what this shows us is that China has been chasing volume sales. The entire industry in China is geared up to keep producing lots of things. So when there's a dip in global demand, the only option that China has is to cut its prices. And as you can see, between 2012 and 2017, China experienced constant year-on-year falls in producer prices. And what this tells us is that all of those companies during that period would have struggled to be making a profit, because if you're constantly cutting your prices but costs are not going down, then that's just going to eat into your profits. And really what this shows us is that there must have been some sort of support from the government for all of these companies, because if this was a capitalist economy and you had year-on-year falling prices and falling profits, at some point those businesses would fail. But obviously the situation in China is slightly different, and it is not a pure capitalist economy. So the current situation where we have year-on-year falling prices will be hurting all of those businesses. And the question is, who's going to foot the bill? Who's going to cover the losses that these companies are making? Will the government bail out all of these businesses, or will they let them go bust? And as we saw recently, Evergrande, which is the company with the most debt in the world, it's got over $300 billion worth of debt, was allowed by the Chinese authorities to go into liquidation. And it will be interesting to see whether or not we see lots of other companies following suit. Now, the other thing I wanted to talk about on this chart is what's happening with consumer prices, because as you can see, the consumer prices haven't been following the producer prices. And prior to the current situation, the last time that China saw falling prices was back in 2020 at the time of the COVID pandemic. However, before that, it was 2009. And I think it's interesting to note that the two charts are not entirely correlated. And of course, the reason for that is that a lot of industry in China is geared up for exports. They're selling things into the international markets. This chart shows the movement in the Purchasing Managers Index in China for both manufacturing businesses and non-manufacturing businesses. Manufacturing is shown by the red line and non-manufacturing by the grey line. And as you can see, in January 2024, the manufacturing PMI was 49.2. And as we've discussed before, this is an index. The scale on the left-hand side is between 40 and 55. And the key issue here is whether or not this index is above or below 50. If it's above 50, then that indicates that businesses are expanding and growing. If it's below 50, then that indicates that businesses are contracting. And the manufacturing index for January is below the critical 50 level. And this is now the fourth consecutive month that manufacturing in China has contracted. And obviously that trend is very concerning, because the Chinese economy is dependent on manufacturing. Manufacturing is the heartbeat of the Chinese economy. So when we've got a contraction in manufacturing businesses, that is very bad news, because it means that the companies are not growing, they're not expanding, and therefore it's difficult to be able to trade your way out of this situation. In the past, China has basically stimulated its economy, it's given it a boost, and that means that manufacturing then starts to expand and everything goes back to normal. But over the last few months, the Chinese authorities have been trying to stimulate the economy. They've been doing everything within their powers, and it's simply not working. This manufacturing index is still sitting below 50, which means that these companies are contracting. And if we look at the movement of the red line since January 2022, you can see that the vast majority of the red line is sitting below the 50 level. There has only been a short period at the start of 2023 when it rose above 50, and that was the period following the removal of all of the COVID-19 lockdown restrictions at the end of 2022. And there was a lot of confidence in the market at that time that China was going to have a very strong trading period during that year. However, that confidence proved to be short-lived, and as you can see, for the vast majority of 2023, the index sat below the 50 level. So this is a long-standing problem in China and is going to be very difficult for the Chinese authorities to fix. This chart shows the movement in the CSI 300 over the last 12 months, and this is the index that includes 300 of the largest companies in China. And as you can see, over the last year, there has been a significant fall. If you've been following the channel, I've talked a lot about the fall in the stock markets in China. And the reason I wanted to show this is to show that over the last couple of days, we've started to see an improvement in the situation. And the reason that the markets have started to go up is in anticipation of what the Chinese authorities are going to do. So as it sits at the moment, there is no fundamental reason why share prices should have started to go up, other than the fact that everybody's expecting something good to happen. Lots of money is likely to flow into the Chinese economy from the government, and that influx of capital should start to improve the situation. And if we expand the chart out to show the position over the last 5 years, you can see that even though there has been a slight improvement over recent days, the position is still the worst that the stock market has been in for 5 years. So this represents a complete disaster at a time when the S&P 500 in the USA is roaring. It's having a great 2024. And I think this really highlights the fundamental problems that exist currently in the Chinese economy. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the last 12 months. And the reason that I wanted to look at this is that given what's going on in the Chinese economy right now and what we've seen happening with the stock markets, you would have expected the Chinese yuan to have fallen in value significantly in recent months. This time 12 months ago, one US dollar was trading for around 6.8 Chinese yuan. Today, it's trading for around 7.2, which represents a year-on-year fall in value of around 6% in the yuan, which for a major currency is quite a significant fall. However, if you look at the situation since July 2023, the value of the yuan hasn't really moved, which is surprising given the issues that the Chinese economy has been facing over the last 6 months or so. And as I've discussed in previous videos, the reason for this is that the Chinese authorities are supporting the yuan. They are buying in the international markets to maintain the price at a level at around 7.2. They don't want to see the currency continually falling in value because firstly, the generally accepted principle in economics is that the value of your currency has a direct correlation to what's happening in your economy. So if your currency is weakening, it tells the world that your economy is also weakening, and the Chinese authorities don't want that message to be out there in the markets. But also, it has a knock-on implication for all of the companies within China that are both importing and exporting goods. So the Chinese authorities are doing everything in their powers to maintain stability in the yuan. But the problem that they're now facing is that this becomes more and more expensive as your economy continues to weaken, because issues such as the withdrawal of foreign investment and the fall in your stock markets mean that there's weakened demand for yuan, and so they will need to be providing more and more support, which is going to cost them billions. So what's the summary and conclusion today? Well, I wanted to post this video because the latest data always tells us exactly what's happening right now. And the latest data for China tells us more bad news. Consumer prices are down for the 4th consecutive month, but they're now accelerating. The fall in prices is gaining momentum. And that's obviously really bad news from the Chinese authorities' point of view, because when you've got momentum, it's very difficult to stop it. And we're seeing this across the board. It's not just in consumer prices, it's in food prices, and it's in producer prices. And producer prices have now fallen in every single one of the last 16 months. That is now a longer term trend. Over the course of 2 or 3 months, you might have put it down to specific factors. It could have been down to the value of the yuan or specific increases in some sort of raw materials. But when you've got 16 months of consecutive falls, that's becoming embedded into the Chinese economy. And those companies are now starting to plan around that. If you're in charge of one of those businesses and you've had 16 consecutive months of falling factory gate prices, you need to start building that into your financial planning to expect that it's likely to continue happening. And if you do that, then you're going to have to start cutting your costs, either making people redundant or reducing their wages or finding other ways to reduce your costs, maybe changing your supply chain, buying cheaper raw materials to try to bring your overall cost down. But obviously the knock-on impact of doing that is that it causes prices to fall for other companies because you're paying less, and therefore it has that knock-on domino effect. Everybody else who's working in China is now having to work on the same assumptions. And so this is why it becomes embedded, because as companies start to factor all of those things into their buying patterns, then it means it's very difficult to change it. And the Chinese authorities are aware of this, and they know that this is now becoming a really big issue for them. And as we've seen from today's data, it's not just prices where China has a problem. The Purchasing Managers Index has now been below the critical 50 level for the last 4 months. And actually, when you look at the period over the last 18 months, it's been below 50 for the majority of that time. So this tells us that companies in China are cautious and they are contracting, and they are fundamental problems. And that's one of the reasons why the stock market has seen a $5 trillion sell-off over the last few months. The market is now at its lowest point that it's been for the last 5 years, and that tells us that there are serious issues happening in China right now. China officially recorded 5.2% GDP growth for 2023 and is expecting to hit around 5% for 2024. But when you look at what's happening in the markets, that doesn't really make sense. That is going to be a miracle if China can get to that position, because when you've got year-on-year falling prices and therefore falling profits, how can you achieve 5.2% GDP growth in 2023 and 5% in 2024? It doesn't really make sense. In order to hit those numbers, you would have expected all of the companies in China to be booming right now, for the stock market to be roaring ahead like it is in the USA. And when you compare the forecast GDP in the USA of around 2.5% for 2024, it doesn't really stack up. So the reason that I wanted to post this video was really just to give you the latest update. I've been talking a lot about China, and I am concerned about what's going on right now and whether or not the 5% target for 2024 is realistic. And when you see month-on-month data telling us that there are continued problems, that prices are still falling, that consumers are still worried, that doesn't indicate that China has turned the corner. And of course, the one thing we haven't spoken about in today's video is the property market. And property equates to around 25% of GDP in China. And the property market is in dire straits right now. There aren't any companies that are doing well. The government is trying to bail out the companies that have got themselves into the situation where they've sold millions of apartments and haven't built them, and consumers are waiting to take ownership of those apartments. But simply bailing out that situation isn't going to fix the property market because it's broken. Consumers in China have lost all confidence. And what we're seeing now is that they're losing confidence in the retail markets as well. They don't want to spend. People are keeping their money in the bank. And that's a major problem for the Chinese authorities, because they need the 1.4 billion people to start spending to drive the economy back up. So when you look at the fundamentals, there are serious issues happening in China right now. There is a serious question mark as to whether or not they're going to hit 5% growth for 2024. And unfortunately, as China is the second largest economy in the world, if it does have a poor 2024, that will definitely have a knock-on impact for the global economy. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.